Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. So today we finally had that oversold bounce that we had been looking for. The last 2 days in the morning note, Scott and I talked about the market was in oversold conditions, one of the two most oversold conditions that we've seen so far this year. We were coming off last week, the worst week for the market in 2013. So obviously it made sense with the macro trend firmly to the upside for us to skew our trades a little bit towards looking for that oversold bounce, and that's what we finally got today. Even though the bounce wasn't all that convincing thanks to a bearish close, we can go ahead and take a look at the chart of the S&P. We had that break yesterday below the 50-day moving average, and the rule that we like to talk about when an index or a stock breaks below its 50-day moving average is how quickly can it reclaim that moving average. If it accelerates below the 50-day or stays below it for a period of 3, 4, 5 days, that tells you there is likely more downside in store. But if the stock or ETF or index ETF can get back above that 50-day moving average or whatever moving average you're talking about, if it can get back above it in a matter of a couple days, then that tells you that perhaps it can find a bottom. And today, like I said, we got some nice strength during the session. We trended higher for most of the day, but we had a bearish close. I can take a look at the 5-minute just to give you a visual of it. Let's go to our East Coast time frame here. As you can see, we trended higher for most of the day. Really nice move as you saw on the daily chart from the top right here that we topped out around 1 p.m. Eastern time. But a bearish close left you with a little bit of a sour taste in your mouth if you're a bull and made today's candlestick not all that convincing as we still closed about near yesterday's opening price. So yes, we got that oversold bounce, but it's not the type of bounce that tells you this is a blaring signal that we are going to immediately snap back, continue to snap back. I'm not saying that I don't think we're going to snap back, but today's candlestick leaves a little bit to be desired and keeps everybody a little bit in neutral. And you can see on the chart there, the 8 and 21 day moving averages are curling down, which is not something you like to see from a bullish perspective. But we continue to get some stock-specific movement today, as has been the case most of August, despite some choppy action in the indices. And today there was a focus in retail, specifically sort of the forgotten retail sector. On both sides of the spectrum, you had some bullish action and some bearish action. Those are some tongue twisters right there in the retail sector and in stocks like JCPenney and Best Buy. We can go ahead and take a look at the chart of JCPenney. The stock came out with its earnings report. Let me go to the JCP here. Came out with its earnings report. It was actually a dismal report. They lost almost $600 million this quarter. They continue to burn through their cash, and it looks like they're on borrowed time right now, but it was one of those things where it's sort of sell the speculation, sell the anticipation of the earnings report, and buy the news. And even though it was a bad report, the stock gapped up. It was a wild day in terms of the intraday action. So I'll go ahead and take a look at the 5-minute chart of that also. You had a big gap up this morning as people, like I said, sort of bought the news of this bad news finally being out. Perhaps there was expectations that it was going to be even worse. But then after the big gap up, you had an initial push higher, and then the thing tanked all the way down and went negative. And I'm sure you had all these dip buyers in JCPenney punching things and breaking monitors and things like that. And then, what do you know, it reverses back up and closes the day near the highs. You go back to the daily chart, the resulting candlestick is a peculiar one, not one you see all that often. But at the end of the day, I guess you could say it's a bullish setup for JCPenney, even though I wouldn't trust it at all. I was going to come up with some sort of analogy there, but not a trustworthy move, not a trustworthy candlestick there for JCPenney. And it's not the type of thing that I'm really all that excited about looking to buy. I do like playing some of those contrarian type setups every once in a while, but there's nothing really with JCPenney, the company or the stock, that really gives me any confidence that they're going to turn it around. But I think what a lot of people are seeing with JCPenney is a lot of parallels to something like Best Buy, a company that was left for dead a couple of years ago. There was talks about taking it private. It was a brick and mortar company that's been taken over by and overrun by things like Amazon in this new era of retail. But Best Buy has responded from the doldrums, and it's back, rip roaring. And today it was up big again after another solid numbers. And you look at the trend there. We can zoom out to, let's go to a weekly chart to get a look at that. And you look at Best Buy, end of 2012, the stock is trading down near $10. After being a $50 stock only a few years earlier, a $60 stock back in 2006. People were saying this stock's bankrupt, the company is destined to fail. And then what do you get when everybody gets bearish on a stock? You get a dang near 400% move here, not quite, about 350% move in Best Buy. Hugely impressive acceleration today above all of its weekly moving averages there, as you can see. But I think what a lot of people they're trying to draw parallels between something like JCPenney and something like Best Buy, and I think that's a dangerous thing to do on the surface, to take situations like that and try to apply broad principles of, okay, it's a brick and mortar retailer that used to be very popular and then lost a lot of its edge. I think there's a lot of complexities involved with both of those cases that make it difficult to apply that. And JCPenney, like I said, it's burning through cash, lost almost $600 million. They expect to have about $1.5 billion in cash on hand at the end of this year, and they have been able to get a little bit more funding, raising debt, but they're on borrowed time. They're continuing to burn through cash, and they're going to really need to turn things around quickly if they're going to make a turnaround, or else I expect the stock to continue to bleed lower. But just a few thoughts there on an interesting dynamic we saw today between the big move in Best Buy higher and then the big move lower. And it finished the day higher, but the big move lower we've seen overall in JCPenney over the last few months to few years. Besides that, going into the tech sector, Apple is obviously been the tip of everyone's tongues in the market over the last few weeks, as it's finally responded and improved its character after a major fall from grace over the last year. But today it ran out a little bit of steam, which is something that was not unexpected given the fact that it had come so far so fast over the last few weeks, thanks in large part due to people like Carl Icahn and Leon Cooperman, big fund investors coming out and supporting the stock. But you take a look at the chart, we finally had that correction, that pullback, whatever you want to call it today. I wouldn't call it a correction, but it was an overbought territory, sort of opposite of the market. Yesterday put in a little bit of a topping type tail. Today actually opened higher, but then faded, engulfed yesterday's bar. I expect just to see some rest in Apple, and then I expect it to continue higher, honestly. I think people, they were a little bit wary of the uncertainty with Apple, and there was a whole concern about no new products and deteriorating margins and everything like that. And the fact that you have all these big names coming out and supporting the stock and talking about new positions they've initiated, I think that's really big psychologically for Apple investors. And like I said, I think after a period of rest to allow these short-term moving averages to play catch-up, the 8-day here, the 21-day below that, I think that'll be really healthy, and I think it'll be a springboard for more upside in Apple. And one thing Apple's proven, if you're concerned about maybe a big market correction, one thing Apple's proved just in the recent past over the last few days is that it's immune a little bit to broader market moves now. It can actually move on its own, not be beholden to what's going on in the broader market. So if you're concerned about a deep market correction, maybe Apple's one that has shown it can actually have a little bit less correlation to the market than it has at times in the past. But Facebook, another name in tech that everybody's been talking about after that big earnings report and the big move following that earnings report. We talked a lot about on Twitter, if you follow us on the social networks, and even on Off the Charts, our premium newsletter, things like that. It's been a hot topic in the VTF as well, about buying the dip in Facebook after some recent weakness. And it's one that I've been pounding the table on. I really believe in the story now. I was completely 180 from that prior to that most recent earnings report, but they had that big jump in mobile ad revenue. It was 26% of their total revenue for mobile ads. Now it's 41%. They have video ads going in people's news feeds in the near future, in addition to the other stuff they've done that allowed them to have that big jump in mobile ad revenue. All of that is expected to add a ton to their bottom line. And then there's even these wild cards like mobile payment systems. They're talking about creating a PayPal competitor, which could be another, like I said, wild card that people aren't really expecting to add a lot to the Facebook bottom line, but could improve their numbers and allow them to continue to beat analyst expectations. So you take a look at the chart of Facebook here. You can see some really nice action over the last 4 days, even the 3 days prior to this in the face of market weakness. We talked about this being, I'll draw the Fibonacci retracement level. Fibonacci retracements are a concept we use in the active trader course. Really great education in that course. We had the webinar last Thursday with Rich and Evan that provided some analysis of these concepts if you're unfamiliar with them. But Fibonacci retracements, one thing we talk about in that course. As you can see, Facebook came down into the 50% fib retracement level from that post-earnings, post-gap move. And that was an area that people were looking for a potential bounce in the absence of really any other support levels that were worth watching. And you got a nice bounce off of that level, and it's continued higher. Not a ton of intraday power, but if you were holding it for a swing trade, which I think is what you should be doing with Facebook, really nice action. And I expect to see Facebook in the 40s in the near future. And that represents a nice percentage move still in Facebook. I think it's a huge growth story. They've proven they've figured out mobile a little bit, and that's what big hedge funds needed to convince them to raise their stakes, big institutional investors to buy into this story. And I think they're doing that now. I think it'll continue to go higher. I think it'll be in the 50s by next year easily. That's just my opinions. I got to state that for disclosures, but I really believe in Facebook at this point. Another one I believe in is Tesla, even though I'm not terribly enthusiastic about buying it up here. I hate to keep saying this, but I started talking about it in the $40 area as I noticed it had about a 50% short float, had a really iconic, intelligent, impressive CEO, Elon Musk, a visionary. He's a businessman second, he's a physicist first, but he does both of those things really well. And if you get a combination like that, it can lead to a lot of stuff. Tesla, during its public life early on, struggled a little bit. Elon Musk sunk the last of his personal fortune into the stock, and boy, has that paid off for him. As you've seen that huge move, even when it was at 40, when I was bullish on the stock, I didn't expect to see it at 150 this quickly, obviously, or even at all. But as you can see, really nice action over the last 4 days. It was Mark Sperling's trade idea of the week, which I help him put together each week. On Monday, we talk over the weekend and the prior, late in the week, formulate an idea, and this is one that we've been stalking and wanting to list, but it sort of came in second a lot of times, a lot of weeks when we were coming up with ideas. But this week it looked like it was too good to ignore. We can go back to the chart and you can see how it bounced off the 21-day moving average. And that's what we really liked about the setup, is that the macro trend is obviously intact. The short-term trend, yes, there was a little bit of downside, but it found support at that 21-day moving average, was hovering around its 8-day starting on Monday, and then it's got some nice movement. One of the big catalysts today, one of the big catalysts before was a Consumer Reports review of the car. This was several months ago, that revealed it graded it as the best car that Consumer Reports had ever reviewed. It gave it a 99 out of 100. It talked about not only does it drive really well, but the interior, the whole car was just a complete masterpiece. And then you came out, we saw reports come out this morning from the government that not only did Consumer Reports give it a 99 out of 100, but the safety rating is the best safety rating they've pretty much ever given to a car. Due to the fact that it doesn't have a big engine in the front, the crumple zone is bigger. These are all just details, but anyways, a great safety rating only adds to the positive buzz and positive marketing for Tesla, and investors saw that as a positive sign, and that led to a gap up today that held. So I expect to see Tesla still carries about a 27% short interest as of Monday when we did that write-up. So there's still a lot of shorts that are left to be squeezed, in addition to anyone who wants to buy in, institutions or anyone that still wants to chase this story. Like I said, from a long-term perspective, I have a tough time justifying chasing Tesla, for multi-month, multi-year swing type trades, but from a short-term perspective, it looks really good for more upside. Maybe after 4 days up, maybe it needs a little bit of rest, but I still expect to see this squeezing up to new highs within the next few weeks. We saw a lot of red dog reversals in the market today, to borrow Scott's phrase that he named after himself. We saw a lot of stocks like the market that were oversold and actually gave us nice calculated setups down through the previous day's low and then back above. That's what a red dog reversal is. You put the stop at the previous day's low and you enter on a break back above that previous day. Or you put the stop at the current day's low and you enter on a break back above the previous day's low. And the perfect example of that was the financials. The XLF is the ETF we use to track the financials. And you can see a perfect red dog reversal setup in that. We actually did a little write-up for StockTwits. They were putting together some of their community's favorite trade setups, and we talked about the red dog reversal, and they asked for an example. So we provided the example today of XLF. As you can see, our criteria is multiple days down, 3 or more days down in a stock or ETF, and then a trade down through, an open above the previous day's low, a trade down through that low, and then a break back above. So the hypothetical entry on this trade would have been back above this 1975 level. You have your stops at the current day's low, which is 1972. So you actually had 3 cents of risk here, which is not always the case with these, but sometimes you can get some really nice risk, really tight risk parameters on these type of trades. And then you see a nice cash flow trade. And I think it could lead to a little bit more. Yes, you have the short-term moving averages curling down, but these red dog reversal type entries, they can be day trades or they can lead to swing trades depending on the context of the chart. And the financials are something that were strong for a long period of time this year, but they've come into some weakness recently, showing some relative weakness. Maybe this is just a 2 or 3 day trade, but a really nice entry there if you're a short-term guy looking for short-term actionable signals in the market. And then Citigroup was the most impressive that I wanted to point out among those banks today. A big engulfing bar. It was even weaker early as it traded down here all the way below 49, but then reversed really impressively. It missed out on a full engulfing bar due to that weak close in the market that I talked about earlier, but still a really impressive candle that I think should lead to some short-term upside as long as the market can keep its footing. And I'll mention a couple other stocks that were mentioned as Mark Sperling's trade ideas of the week, just coincidentally, and they performed well today and have performed well over the last several days. Green Mountain GMCR, one that I really liked in just this upper level channel. If you had tighter stops, I can't remember what the risk parameters were on that trade idea. The trade ideas are meant to be educational as much as anything, to give you some insight into the way we come up with ideas. Obviously, we try to come up with good ideas, but the concept with GMCR was that it's just in an upper level base since this earnings gap up, really reminiscent of the gap up and base type of formations that we saw in Netflix over the last year or so. And GMCR really loved this upper level base. It never came close to even breaching that upper level base. So if you were doing it from a swing trading perspective and giving yourself to the bottom end of the base, you obviously had no reason to even think about getting out of this trade. And now it's making new 52-week highs. It closed just off of making a new 52-week high, but I think it made a new 52-week closing high. But this is one that looks like it has more upside. It's another one that has a big short float, a lot of naysayers, a lot of people stubborn, looking for the downside in this stock, which they got for a period of time, but it's had a really impressive comeback. Much like Netflix, again, those two have a very similar looking chart. A really impressive move today in GMCR. Short term, 3 potent days up. It needs some rest, but it's one that could easily squeeze, I think, into the mid to high 80s and then potentially beyond after that. Another one, Pandora, is one that has really done a great job of shrugging off competition in the form of Spotify, in the form of Apple's new streaming radio service. They continue to get more usership, and the growth story continues there with Pandora. And it's one that in the short term, I think it narrowly triggered some stop parameters that we included in that trade idea. But after that, if you were on the VTF, if you were paying attention, people have gotten back involved with it, and some really nice price action as it's held above. It hasn't had a close below the 21-day moving average over the last few weeks. So really impressive action there. Today, it was a little bit overbought perhaps, but this is one that I would continue to look for. The trend in multiple time frames is to the upside, so one to continue to watch as a growth name, as a high momentum, high beta name. But that'll about do it for today's recap. I think in summary, the market, like I said, it got that oversold bounce that we were looking for, but the bounce wasn't all that impressive to the point that you're enthusiastic about buying this dip now. I think everybody's sort of in wait-and-see mode for the September Fed rate decision. Bonds were a little bit resurgent today, maybe showing that people are hedging their bets a little bit on whether the Fed is going to taper in September. But I think there's a lot of mixed signals in the market right now about whether, in fact, that taper is going to come. So I think right now a lot of people, like I said, in wait-and-see mode, choosing to pare down risk a little bit in the dog days of summer. And I think that's a prudent thing to do at this point. This has been John Darsie here for your daily recap. We'll see you out here tomorrow morning.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.